Hi, welcome to Jimmy on the Saddle. My name is Jimmy Cho. I'm a realtor at eXp Realty. Federal Reserve just announced last week that they will use its full range of tools to help US economy in this challenging time, promoting maximum employment and controlling inflation goals. They're expected to maintain an accommodative stance of monetary policy until 2023, which means they will keep this low interest rate for a couple of more years from now on. As the rate fell historically low, many of us probably wondered whether to refinance or not. Today, we'll study a topic of refinance with Ryan Hrisca. Okay, Ryan, could you briefly introduce yourself?
Yeah, my name is Ryan Hrisca. I run and manage a small team here of mortgage professionals here at Loan Lock in beautiful Orange County, California. Been doing this for about 20 years. Only thing I know, God help me if I ever try to get out of it.
You probably receive a lot of inquiries for refinancing. First of all, who do you think should consider refinance?
That's a great question. I know we got a lot of noise going on out there with the historically low rates and what we're seeing with going on with the feds and the economy. But to answer it simply, it's a per client basis, what your short-term and long-term goals are. The major one we see is a regular rate and term refinance where you drop your interest rate, lower your monthly payment, and save hundreds, if not thousands of dollars a year. The other major one is shortening the term of the loan, going from either a 30-year fixed down to a 20-year fixed, or even a 15 or a 10-year fixed. And that one is definitely a per client basis to make sure you don't bite off a little too much more than you can chew with that monthly payment. The other option is Americans have the most equity in their homes than ever before seen in the history of the lending world. And it's a great opportunity for many clients to consolidate debt, turn bad debt into a tax deductible debt by rolling it into your mortgage, ensuring that you're not taking out too much more than need be to make sure you reach those goals. And you can oftentimes, I've seen clients save upwards of $3,000 a month just by consolidating debt. Another one could possibly be, if needed, you can buy out a spouse on an ex that if you're in the process of divorce. It's considered a rate and term refinance, so you have more leniency, you have a better interest rate if need be to buy out the ex, so you can stay in your home as they go on their merry way. Another great option is if you have student loan debt, you have more leniency when it comes to refinancing and being able to consolidate it, paying off that debt directly through the close of escrow on the refinance, which will again convert that funds into a tax deductible vehicle and have greater deduction power when you file your taxes at the end of the year. And another major one we're seeing as well, clients that purchased a home with FHA financing, the monthly PMI is fixed in for the life of the loan on most occasions, and we're seeing clients convert from an FHA loan into a conventional loan, reducing greatly, if not altogether eliminating, monthly PMI on their mortgage payments, so saving on the interest rate and also saving on, if not shaving off, the PMI completely.
Wow, as I hear your answer, Ryan, there must be a lot of group of people who should be interested in refinancing.
Yeah, there's a ton of people out there, but again, it's one of those, what is your short-term and long-term goals, and it's very important to align yourself with a mortgage professional, not to sell you a rate and a payment, but really dig in and see how you can benefit to the greatest.
I see. Are there any rules of thumb for refinancing decisions?
Yeah, that's a great question. We get that all the time, and we hear a lot of rules of thumb, whether young and old. But the classic one we always hear is if you don't save at least 1% on your interest rate, then you shouldn't be refinancing, which couldn't be further from the truth. Again, it's a per client basis. However, if you're on the higher end spectrum of loan amounts, even a quarter to 3/8 in rate drop could see a substantial savings on your monthly payment. So it's something to definitely, ask mom and dad, Uncle Ted. God, they love you. They're going to give you their best opinion, but speak with a mortgage professional that's also going to give you, sound advice and insight to the numbers.
Home values went up so much nowadays, there must be a lot of homeowners who will be free from PMI requirement. So could you briefly explain what is PMI and its removal?
PMI, private mortgage insurance, is simply, to boil it down, is an insurance policy for the mortgage lender, the bank, the servicer, whoever you pay. God forbid you had to get short sold upon or the home was foreclosed upon, that they would never take a loss on the property. Going back to the Lord gives and the banks take. So they always have their butts covered, and that's what PMI is, why it's required if you don't put down at least 20%.
How can we remove that?
Monthly PMI can be removed on conventional financing when you have at least 20% equity in the home. There is an option also to buy it outright. So if you have 10% equity or 15% and just don't have that 20%, you can also buy it out through the refinance, but it could get costly, so it's definitely good to look into that. VA veterans, VA home loans, they never have monthly PMI, as they shouldn't. God bless them, we thank them, but they never have PMI. FHA financing, that PMI in most occasions, again there are exceptions, but in most occasions the PMI is fixed in for life. So if you do hold a FHA mortgage, in order to get out of that PMI, you're gonna have to refinance into a conventional loan. And you're gonna have to have the 20% equity.
Wow, thank you, Ryan. That's so useful information. The next one is not particularly related to refinancing topics, but it has been a big decision when we get a mortgage. So between 15-year and 30-year fixed mortgage, what do you think we should take it into consideration?
Well, if you're going from a 30 to a 15, you really need to figure out what your short and long-term goals are. Are you gonna stay in that mortgage for 15 years at least? Additionally, oftentimes, if you go from a 30 to a 15 and you have not refinanced in the last 10 years, you might even be able to keep your payment the same, if not possibly lower it, and shave off a handful of years by going into a 15-year fixed mortgage. Now, we could give you a 1% interest rate on a 15-year fixed mortgage, but your payment's always going to be substantially higher than a 30-year if you just got the mortgage or purchased your home. So when you're looking at a 30-year, that's obviously gonna, with the amortization on that, it's gonna give you the lowest rate the lowest payment per month. A 15-year fixed is definitely gonna help get you to pay off that home a lot quicker, but you gotta consider the monthly payment.
I see. Now, for those who are considering to refinance, what are the common mistakes by borrower?
I know this sounds crazy, but you never want to solely focus on the interest rate. That's the number one mistake we see most clients make. One good example is they go to a lender online and they're quoting them a 2% interest rate that does not really exist, but they're paying points for it. So you really need to consider when you're refinancing the cost versus the savings. And many people focus on that rate but don't realize, hey, I'm paying $7,000 to save $100 a month. How long is it going to take me to recoup that cost? That is probably the number one mistake we see. But you really just need to dig into the numbers with a mortgage professional, understand and really pencil out what your short-term gains are, what your long-term gains are, because most people are not going to be in their mortgage for 30 years when we look at the historical charts on that. So really digging into the numbers with a mortgage professional that's going to air all those out for you.
So my last question is, what do I need to qualify for refinance?
Well, there's a couple programs out there that don't require much documentation at all, no income, no asset documentation. They're FHA and VA products. They have a streamlined refinance option. That option just makes sure that you are who you say you are with documentation. You've made your mortgage payment on time for the last 12 months, and you don't even need an appraisal. If you're self-employed, oftentimes we can get away with 1 year of tax returns, but self-employed clients definitely do need to give more documents than most. Tax returns, business and personal, pay stubs if they pay themselves W-2s, W-2, so they're pretty much full documentation. Often we're seeing right now are streamlined refinances with full documentation. And what I mean by that is oftentimes when we run it through Fannie and Freddie's system, it'll kick back that we might only even need pay stubs and bank statements and documentation on your current mortgage. So gone are the years where you always have to have a full 2 years of tax returns and a full 2 years of W-2s, which is a very good thing because they're really streamlining it for a lot of clients of ours.
Oh, Ryan, thank you so much for sharing the valuable information. I'm sure the information you shared with us will help our audience to make a smarter decision on refinancing.
I hope so. Thank you for having me, and thanks for bringing up this topic, because it's a very good topic to discuss right now in the current environment.
Thank you so much. Why don't we give a big hand to Ryan?
Oh, tip your waitress.
Yeah. Okay, I'm gonna put up his contact information in this video, so please feel free to call him or email him if you need further information. Thank you.
Thank you.
Bye bye.